Okay, I've been getting the same questions over and over again recently. And what do I always do when I get the same question over and over again? I'll either write it up or do a video so I don't have to keep answering the same question and you guys will get the information. So interestingly enough, I'm actually answering questions on both sides of kind of the mortgage equation. I'm getting questions about purchasing a new home as well as refinancing a home as rates start to rise here, and it's kind of determining when is the best time to do that and what makes sense. So let me tackle the first one, and probably the most common right now is, when is the right time to purchase a home? This is kind of one of those big misconceptions out there, or at least people are taking the wrong perspective on it. A lot of times when we think about when is the right time to buy a home, we're trying to think about, when are the best mortgage rates, and what are the rates, what are the interest rates, those sorts of things, right? And really, I would actually rank the three factors, I actually wrote them up here on the board, are kind of the top three factors you should consider when you're thinking about purchasing a home. Because fact of the matter is, over the span of like the last 5 years, almost the last decade, interest rates really haven't changed that much. Probably on a monthly payment basis, probably less than $50 a month. And interest rates themselves have at the highest and lowest points have been right around maybe a whole percentage, if that. But so there's not a lot of fluctuation in there. So it's probably not your biggest factor. If you bought anything in the last 5 to 10 years, you probably bought at about the same interest rate as everybody else. Okay, so let's kind of throw that factor out as kind of a ladder consideration. And these are the top three things that I think you should be thinking about if you're going to buy a home. Okay, so first and foremost, it's a little bit of a unique situation in the sense that you need shelter, you need a house. So you're either renting a house or you're buying a house. And so really the determinant between the two of those is really kind of positioning of where you are in life as to whether or not it makes sense for you to be a renter or be a homeowner. Because at the end of the day, you're going to pay out that money one way or another. So here's what I consider first. Where are you as far as what do you expect to be in the next 5 to 10 years? Will the place that you're looking, is that the place that you want to live? And will you be stable over that 5 to 10 years? Because that's about the right amount of time to be in a mortgage where you can make sure that you're going to gain probably a little bit of equity. You're going to absorb any cycles in the market. And as a result, you probably have accumulated some home equity. So first and foremost, are you going to be here wherever you're looking to buy a home over the next 5 to 10 years? If the answer to that question is yeah, probably, I'm feeling pretty stable. My life situation, my family situation, my job and career situation are pretty stable. Then you probably check that one off as a positive towards actually getting a mortgage. The other thing, and this is the one that impacts the actual interest rate that you're going to pay the most, is really your credit profile. So take a look at yourself. There's lots of resources to do this. Some of it you can do your own math, and some of it you can actually use one of these free credit score providers like Credit Karma or Credit Sesame that we recommend, and you can figure out what your credit score is. But is your credit profile good? So generally that means something with a credit score of 680 and above, which is kind of the first determinant, but it's not the only one. The other thing that we're looking for is our debt compared to our monthly income sort of under control, if you will. And so what is that debt to income ratio? We're looking for that to be no more than about 35% of your income is actually being used to pay your monthly debt requirements. These are things like minimum credit card payments, your auto loan payment, and those sorts of things. So we want to see that ratio about 35%. So again, paying no more than 35% of your income towards monthly debt obligations. And then the last one, and this may surprise you, but then the last one is kind of your current financial situation. Like I said, you're already having to pay this housing payment one way or another anyway. So at this point, all we're looking for is, again, some stability in your financial picture. So you will have to do a down payment, and you will have to pay some closing costs. So your financial situation needs to be probably a little better than the average American, in that you have to have some savings set aside. So for a down payment, you need at least 3% down. If you're going to do FHA loan, which is a very popular loan type for first-time homeowners, that would be 3.5%. So let's assume you're buying a $200,000 home. For your down payment, you're going to be looking for anywhere from $6,000 to $7,000 that you need for your down payment as a minimum. And then you're going to look for some closing costs. Kind of a rule of thumb is anywhere from 1 to 1.5%. So again, on that same $200,000 home, you're looking to have somewhere between $2,000 and $3,000. So all total, probably first-time home buyer, it's probably a pretty good estimate that you want to have some savings to put towards that mortgage of about $10,000 just to kind of get you started. And then in addition to that, of course, we want to see some reserves, some savings. So hopefully you've got anywhere from $2,000 to maybe 3 months worth of gross income saved up. So those are the three things. Where are you at in life? Do you expect to live here for a period of time? Number two, what does your credit profile look like? We want to see that to be good because that's going to give you the lowest cost of your loan. And number three, what is your overall sort of financial picture or savings picture? Do you have enough saved up so that you can affordably go into that home without breaking the bank? Okay, so let's flip to the refinance side. This is probably the more interesting because as rates have begun to rise, most people have assumed that refinancing is just off the table. It's because they just assume that the rates will go up higher and therefore you can't get a better rate or a better payment. But that is probably not necessarily true in a whole bunch of cases. So there are some reasons, even in a rising rate environment, and it hasn't risen that much. We're still at historically low rates. So there's a possibility that you were kind of just asleep at the wheel, or maybe, and this is very popular or common, your credit profile just wasn't quite as good as it is now because the economy's sort of improved. You probably paid out some debt. Maybe your credit score has gotten better. Maybe you have more income. So there's a good possibility that you are actually paying an above market interest rate. And you could possibly still, even though interest rates are rising, get a better interest rate. So that's first and foremost. It's not on my board, but that's a pretty common thing. So it's reasonable to kind of check your mortgage statement, look at what your prevailing rate is, and then know that kind of right now at our current rate, and this is just a general wag, it could change a little bit, but the average 30-year fixed is probably going somewhere about 4.25 or 4.5. So that's kind of a range so you can look at the mortgage statement and say, hey, have I just kind of missed the fact that I'm paying more than everybody else? So take a look at that. But probably the most popular reason that you might want to refinance and that you could still potentially save money, even if your interest rate were to go up slightly, is again that credit profile improving for all the reasons that I stated, and you potentially wanting to refi out of your FHA loan or potentially even a conventional loan where now because housing prices have increased and the value of your home has gone up, and you maybe paid down over several years some equity, even if your interest rate were to go up a little bit, there's a good possibility that by getting rid of that mortgage insurance, which sometimes can be $100 or so out of your mortgage payment, your payment will actually go down and just kind of take advantage of accelerating out that mortgage insurance. The other reason is, again, part of this acceleration process, and that is you just want to pay your mortgage off faster. Again, depending on where you were when you got, let's say, your 30-year fixed rate, there's a good possibility that you could come in and get a 15-year mortgage where you get a rate break because it's a shorter term. And of course, because it's a shorter term, you're going to pay less interest. And so there's a good possibility that you could actually refinance down into a 15-year mortgage and potentially not have too much of a payment shock, but your overall total cost of that mortgage over the next 15 years could really accelerate and lessen the amount of total cost you're going to have in paying for your house once it's paid off. And we're also seeing some people that have been in their homes for, let's say, 10, 13 years. They're starting to be empty nesters or maybe getting to that point where they kind of want to align things with their retirement. So they want to have their house paid off when they retire. They want to have their house paid off when their kids graduate from college. And so that's another sort of consideration in there. And then the third, and again, this is becoming more and more popular, and it will continue to get popular as these homes accumulate more and more value in them. There's this kind of concept of home equity being trapped in there and available, and at a relatively low rate, like 4.25%, 4.5%. It's probably the cheapest way to actually borrow funds. So you could actually borrow and take a cash out of that equity in your home to do things that would maybe add more value to home improvement. Or maybe you're paying 12, 13, 14% on some credit cards that got a little out of hand and you want to bring that debt under control. Again, you can take, even if you're taking your interest rate up from like a 3.99 to, let's say, 4.5% to take some cash out, you're essentially borrowing that money at 4.5%, paying off something at 12, and as a result, you're saving about 8% of your own money there. So that's another reason to potentially refi. So recapping those reasons to refi, even when mortgage rates are rising: 1, get rid of mortgage insurance; 2, start to pay that mortgage off even faster because everything's gotten better from your financial perspective; or 3, take some of that home equity out in cash and pay off either higher rate debt or potentially improve your home and drive its value up even higher. So that's all from My Perfect Mortgage. If you have any questions, reach out to me. All my contact information is here. And then, of course, you can always see us on My Perfect Mortgage.